Good day, Toronto. And on this month's podcast, I brought on my accountant, Pirasaanth. You'll hear me call him PV throughout the entire conversation, so don't be confused. But he's been managing a lot of our clients and my own portfolio and the company for some time. And we also, like I and my team, also get a lot of questions about, tax reasons, optimizations, and efficiencies. So I figured we try to schedule something a few times, but brought him on eventually. That's why this month's podcast is a little bit late. But we'll be talking about how to optimize your portfolio for taxes, the infamous question of whether you should be incorporating or not. Then we talk about the three-tiered structure that a lot of people have set up for those who plan to hold real estate for a long time. They also dabble into kind of what kind of investment strategies him and his partners are doing right now. Some of the things that we're doing, what we're seeing. On top of that, we also get into questions that some of my clients have asked about capital gains, how to pick an accountant when you're retiring. And then, we go on off a little bit tangent about why RRSPs are actually a scam. Although we think it was a hot take, but I think it turns out it wasn't that much of a hot take between us, right? So we kind of chit chat a lot of things about just generally life experience, real estate investing experience, and just how we're looking at the real estate investing landscape as a investor and accountant, but also investors ourselves, right? So hope you guys enjoy this conversation. And if you guys have any questions for us, you can reach out to me using the chat, the link on the chat below, which is www.chavzan.com. Or you're looking for PV, I'll also put his link for contact in the description. Or if you're listening to this via podcast, it'll be in the description. Okay. So hope you guys enjoy this podcast. Enjoy. See ya. Good day, Toronto. Welcome to another episode of the Prime Properties TO podcast. I'm blessed to have my personal accountant on my podcast finally. We got Pirasaanth here. I want to say hi to everybody.
Hey, Zen. Thanks for having me on the podcast, man. Looking forward to chatting.
No, for sure. Thank you for being busy and coming on to the podcast. Yeah, we've had a lot of people asking me a lot about accountant questions in regards to real estate investing. And I always sound look, I'm not an accountant. I have a really good one. And this is what he's taught me so far, but don't take it verbatim. Yeah. So do you want to tell us a little bit about how you got into this very niche specific real estate investor kind of accounting?
Yeah, for sure, man. It's definitely a journey. So, initially, most traditional accountants, I went down the CPA/CA route and I started off at a big four accounting firm, was working my way up there and, ran into the challenge of I'm working these crazy hours. This doesn't seem to be the way that I'm going to be able to build wealth. So how do I actually make some serious money? And that's how I found real estate investing just personally. So, I started doing some research, attending networking events, and became a real estate investor myself. Started investing in properties, learned the BRRRR strategy, did a lot of networking. And the next thing me and my partner actually at the firm are buying a bunch of investment properties in London, Ontario, eventually trading up into the multifamily space and building a solid portfolio as real estate investors. So how the accounting side fit in is, again, we were always very entrepreneurial people and we wanted to start our own business. Naturally, an accounting firm was an easy transition for us and something that we understood. And, we had the skills that we built up and we decided to start an accounting practice. Funny enough, initially, we were in the tech startup space. So we had worked with some startups during our time at the Big Four. It was the sexy thing in town, the different stock composition transactions, acquisitions, mergers, all that cool stuff. So that was our niche. But as we went to real estate events as investors to just network with other investors and learn different strategies, a lot of people started approaching us and asking us, hey, how are you doing this from a tax perspective? How are you planning that? And just from our own research and learning and courses that we had taken for our own portfolio, we had the answers to these questions. So very quickly, we realized there's a need for this niche. And, a lot of people did want an accountant who could service them as an investor and is an investor themselves. So we don't just bring that accountant only mindset. We also have the investor mindset because, sometimes there's going to be situations where, yes, you want to keep your tax bill as efficient as possible. But, in some situations, it makes more sense to pay the taxes so you can qualify for financing and further scale up the portfolio. So bringing that holistic view was a need in the market. And, fast forward 5 years, here we are.
Yeah, you guys have built up a sizable kind of portfolio from what I know and a good client base. Everybody that's my end working with you is generally pretty happy. Yeah. Very happy. They're like, oh my God, I love talking to PV just because he's like, oh yeah, he knows all this stuff and he understands it from a real estate investor's mindset, right? Like that's, I think, really, really key, right?
Mm-hmm.
And it sounds like from the entrepreneurial side, you guys kind of just, took it by the horn because you're like, you know what, this is something that I personally am doing. And if I can end up making, money on it because I'm passionate about it, that's actually, I find, the best type of people to work with, right?
Yeah, for sure. And that was the key thing. It was
Yeah.
something that we were passionate about, And like a lot of the times when I'm talking to my clients, I enjoy actually hearing about, how their portfolio is going, what kind of landlord struggles are they going to.
There's always the crappy stories,
Yeah, exactly. You can always relate, oh, my lender came and wants a phase 2 report at the 11th hour. Just all kinds of stuff you can relate to.
Floods, furnace breakings, and ACs breaking for me this year. Oh my goodness.
Oh, I hear you.
Yeah. So like, I find anyone who, if you're listening to this, like PV is a great resource because, kind of where we came from, we all were investors first, and we kind of just started expanding our actual business, like your side from the accounting and my side from the real estate, because we're just kind of scratching our own backs. And I find in working with a lot of like professionals in the last 10 years in my trading, the ones who are passionate about what they do and also do it for themselves tend to be the best, right? Mm-hmm. It's kind of like, you don't want to, take gym and nutrition advice from like a fat trainer, right? And I don't think that's like anyone who's like, I'm just saying like the optics of it don't look good,
Right. I hear you, man. And again, that passion definitely goes a long way.
Yeah. So one of the major things, right, that I think everyone always asks me is like, and it always is going to be kind of like, it depends situation to situation, right? Mm-hmm. But I'm going to ask it for you anyways.
For sure.
Should you incorporate before you buy your investment properties? Yes and no. And from there, when should you incorporate? So that's probably the box of worms we're going to go down for hours.
Yeah, for sure. So, you kind of already spoiler alerted the answer there then. But you know what? If your accountant or whoever's advising you doesn't tell you it depends, that's the wrong answer. So it really does depend, because that answer is going to be built on a few different moving puzzle pieces, which you need to fit in and see if, is it the best idea to incorporate right now before that first property or not? So, before we get into what the answer is and what the various pieces are, let's start by going over just some of the straight up facts, right? Yeah. So if you have a corporation and you purchase a rental property and put it in the corporation earns its rental income and starts generating a positive net income. That net income is going to be subject to the passive investment tax rate, which is 50%.
Okay, so I'm going to stop you there just because we got a little bit of technical. I'm going to add in a little fact. So in this scenario, you bought the property in the corporation.
Yeah.
So exactly. Everyone's following along, right?
Yeah, exactly. Yeah. So just to clarify, going back to the overall question, should I incorporate before a property? In the scenario I'm describing, you went ahead, you incorporated, and you purchased your property in the corporation. Yeah. Now, all the net income at the end of the year, after the rent comes in, the property taxes go out, the insurance goes out, mortgage interest goes out, repairs and maintenance, your net profit in that corporation is going to be subject to the passive investment tax rate, which is approximately 50%. Very much less than ideal, right? So, there's a structure in place that real estate investors use in order to essentially mitigate that and make things more tax efficient, which we'll get into in a second. But going back to the initial question is, should I incorporate or not? Right? Let's say if you personally are making $60,000 a year and, you're in a tax bracket that's approximately around, 32-ish%. That's a lot better than paying 50% in the corporation. In that situation, it would make sense for you to keep that property personally, right? At least that first one, you could even tack on a few. It really comes down to what your personal income is, whether that's employment income, dividend income, interest income, holistically what that income is. And then if you now adding net rental income onto there, what effect does that have on your overall taxable income? What tax bracket does that put you into? Are the big variables that you need to be considering in this decision. Now, let's say you're already a high income earner and you're above $220,000, right? Once you're at $220,000, you're already in the highest tax bracket now. Every dollar you earn there, you're going to be paying 53 cents in taxes. So in that situation, it makes sense for you right away to go ahead and incorporate, because that incorporation tax rate is going to be lower. And again, you can take advantage of the three-tiered structure, which we'll get into in a minute as well. So my best advice would be sit down with your accountant and understand, what kind of properties you're going to be purchasing. Are they going to be ones that are going to be long-term rentals that are going to have cash flow and generate significant income? And then factor it and essentially sit down with them and do that calculation. This is my personal income. This is how much is going to be earned by these properties. Is it going to be better for me to utilize a three-tiered structure or to keep these personally?
Yeah, I think you've basically answered a lot of questions for a lot of people, but there's a lot of context that people won't understand without actually going through the minutia of like doing it. You know, the thing
Yeah.
let's you take off your accountant hat and
Okay.
I'll take off my realtor hat, but let's just put our investor hats on, right?
Yeah.
You know, to answer your question, like depending on how you qualify for these mortgages, that's also going to be another kind of component into whether you incorporate or not as well, right?
Yeah, exactly. That's a completely different piece. So everything I just explained was purely from a tax perspective alone, right? Like you want to pay the least amount of taxes or be in the most tax efficient perspective. That's what I talked about. Yes, now with the corporation, there's a whole different world opened up from a financing perspective, especially as you grow your portfolio. They look at the assets. They look at the corporation as its own entity and finance it based on the incomes and revenues that the corporation is generating solely without looking at your personal debts and stuff like that. Unless, of course, I can go into all the intricacies.
I know we got into it. We'll have to bring the mortgage brokers on next time. But let's keep it to the accounting and investor side.
Yeah, exactly. So for sure, Zen, there's definitely situations where it makes sense, given your goals, especially if you're going to be purchasing a lot of properties and you're going to have the opportunity to get great financing and really scale up your portfolio, where it makes sense for you to set up the three-tiered structure right away and grow that portfolio. And in the beginning, based on your taxable situation, there could be an instance where the three-tier structure is a little bit more expensive versus you had the properties personally. However, you're going to make so much more money purchasing the properties that it's just going to be a cost of business.
Oh, of course, right. And like I was just trying to explain to some like new investors, right? Everyone's always concerned about how much taxes they're going to pay, right? But I'm like, if you're making money, you should be paying taxes, right? and then it's always a thing, right? Sorry, catch up. Go ahead.
No, I was going to say, as an accountant, man, you will not believe the amount of times I have these conversations with some of my clients where they're just pissed that they have to pay the taxes. And, sometimes they're so fed up on the tax portion that like, it's almost deterring them from making the move to make more money.
Yes.
And I'm like, yes, you're paying more taxes, my friend, but you're going to make more money. You could just simply not make more money and not pay taxes, or, earn the revenue and break off the government their piece. But
yeah, was it you who told me like, tax evasion is illegal, but tax optimization is what we're trying to do.
Yeah, that wasn't me, but that is a very common line. Like, tax evasion definitely illegal, but we want to, we have our set of rules, and we're going to make sure that we play within those rules and have things as efficient as possible.
Yeah, exactly. And I think that's why if anyone is going to be like a long-time investor and they're going to do this, maybe replace their income or do this as like a serious side hustle for a while, you really need to talk to an accountant who understands all of this, right? Because while PV understands the tax rules and the tax laws, right? If you don't put on your investor hat to kind of figure out how you're going to buy more properties, being tax optimized isn't necessarily the best thing, right?
Right.
Like I always tell people, like, look, there's 4 components to like the investing side, right? You're 4 professionals. You got your real estate guy or realtor like me. Then you got the mortgage on the financing. Then you got the accountant like PV, and you also got the legal side. And there's no one strategy where it's optimized for all 4. Like you got to give and take from all 4, right?
Exactly. And the key example that we're talking about now is very often you'll have to give on the tax side and pay more taxes in order to get those other acquisitions through. And then long term, right? Real estate's a long-term game. You're going to be laughing at the amount of taxes that you paid compared to the revenues that you earned.
Yeah, I think the big thing for most people, like they think really far out, but then they don't realize the cost to set up, say, like this 3-tiered corporate structure we'll talk about a little bit after. But if you're going to do this for a long time and you hold multiple properties for like 5-10 years, like the tiered structure is fantastic. It really is. But sometimes you just don't see the gains of it right away until your portfolio gets bigger, right? Because sometimes you're like, why am I reporting zero on this for no reason?
Yeah, exactly. For sure. And it's important to get those things set up in advance and make sure that you're set up for success, because you want to be proactive versus reactive. When it's too late and you come to your accountant and you're scrambling to try to minimize taxes, or even get in a position where you can go ahead and acquire more properties. If things are set up correctly from the beginning, you'll have a much easier time.
So what PV is low key saying is, like, if you talk to him on April 29th or June 29th for taxes, it's too late. It's too late.
There's only so much we can do.
Yeah, for sure. Okay, so let's get into kind of the tiered structure, right? Most of our clients are long-term investors, right? Buy and hold or BRRRR clients. And if you hold this thing in a corporation, obviously makes sense. But how would this tiered structure work?
Yeah, for sure. So, quickly rewinding to what we had spoken earlier, if you have your properties in a corporation, again, that net rental income is going to be subject to the passive investment tax rate, which is 50%. So what you do with a three-tiered structure now is, if you visualize a triangle, right? At the apex of the triangle, we're going to have a holding company. That holding company is going to own the subsidiary companies at the bottom two corners of the triangle. So in the bottom right corner of the triangle, you're going to have what we call the real estate company. This is the company that's going to own all of the real estate. All of the properties are going to go in there. Initial rental income flows through there, and then initial direct property expenses are going to go through there as well. Then on the left corner of the triangle, we're going to have the property management company. Now, with the three-tiered structure now, initially in your real estate company, bottom right corner, all the properties are in there. The rental income goes through. The expenses go out, the direct expenses, right? Repairs and maintenance, property taxes, mortgage interest, etc. And now you have your net profit.
Yeah.
The property management company is now going to charge a management fee over to that real estate company and shift a good chunk of that income into the property management company. Now, this is due to the fact that the property management company is responsible for the overall oversight and management of the portfolio from a strategic perspective. It doesn't necessarily have to mean active management, because a lot of clients get worried that, okay, well, how am I charging a property management fee if I'm already paying a property manager in the real estate company?
Common question.
So this is a different type of property management fee, right? It's justified by the overall management and strategic management that's required for the properties. You guys are managing the renovations, you're managing acquisitions, underwriting deals, things like that. So that management fee is now charged into the property management company, which is actually inherently an active business in nature. And due to the fact that it's an active business in nature, it's going to have a tax rate of 12.2% on the income that it earns, versus the real estate company, given that it's passive income in nature, is going to be paying approximately 50% in taxes.
Yeah, it's a really big spread, right? So if anyone kind of didn't catch the gist of it, you're converting your income that is normally taxed at 50% in the real estate company, right? Into a portion that's taxed at 12.5%, which is active.
Yeah, exactly.
Yeah.
And so that's a huge amount of tax savings by leveraging this mechanism. Now, you have that income into the property management company, and your long-term plan is you want to continue to have more capital injected into the real estate company, have it continue to grow and purchase more property. So now the money that's sitting in this property management company, after paying the 12.2% tax, you want that money back into the real estate company so you can further use that capital to purchase and continue acquiring properties. So that's why you have the holding company at the top that owns both of them. Therefore, you can do an intercompany dividend from the property management company up to the holding company, because it's owned by that organization. And then that holding company can then intercompany dividend the money back into the real estate corporation. Money's back in there, and now you can utilize to go ahead and purchase more real estate. Now, with the structure, the thing you have to consider, and again, that's why for some people, it may not make sense for them to set it up right away. A lot of the higher net worth individuals, it definitely does make sense to set it up right away. But the reason is you're going to have to set up 3 corporations. You're going to have to file an NTR and T2 tax return for each corporation. So there's compliance costs associated with the structure. So usually you have to look at it as, will the tax savings I'm going to get from using the structure justify the compliance costs that I'm going to be paying for it? Or on the flip end, will the structure allow me to acquire more properties and help me scale up faster so that my portfolio is going to be growing at a good rate, versus do I want to focus on the compliance costs, right? So it's a trade-off.
And I think that's the key thing that I'm going to drill into some more, right? Like you got long-term thinkers who are more buy and hold investors and burrs,
Mhm.
right? And then you got people who are just like, oh, I may or may not even like real estate investing. Maybe, they get their first tenant call like, oh my God, this toilet is
Yeah,
clogged at 2 a.m., right?
right.
And then they're like, okay, I'm done with this, right? So
Yeah,
that's why I always tell like, you got to just try one property first,
yeah.
right? Because if you're all so focused on optimization of taxes, you lose sight of just acquiring more properties, right?
Yep, exactly. And that scalability that the corporate structures and types of commercial financing
Oh yes,
can
okay. All
offer
right.
you is a whole different ball game.
Okay, let's go then. Okay, so here's another
Yep,
benefit to corporations. Let's
yep,
take off your accountant hat and let's
yep,
go into an investor hat.
yeah.
What are the benefits that you see from the investor side that, as an accountant, of the benefits of multiple properties under a corporation?
Yeah, for sure. So like the big benefit is again, they treat that corporation as its own entity, which is inherently what a corporation is.
Yeah.
But as long as you have the right type of properties in there. So for example, if all your properties are cash flowing properties and they're earning good income, when they underwrite the mortgage for your corporation, they're going to consider a good chunk. Depending on who you use, some lenders will use 100% of that income. Some of the more conservative ones will still knock it down to 60% or whatever
Yeah.
it is. But I find you do have an easier time qualifying for finances because now they're looking at that individual entity and okay, it's generating a whole bunch of cash. They're not concerned about your personal debts anymore. Now, based on the income coming into this into this corporation, it can self-sustain and it can qualify in debt service for 3, 4, 5 more properties. And again, you even show them that the new properties you're going to be purchasing will be cash flowing. You will be utilizing the BRRRR strategy, whatever it is. And this entity can sustain itself and keep borrowing. Right.
Yeah.
And then another unique thing is too, where let's say you're in a situation where some of your properties, some purchase one that isn't going to cash flow initially until you do the rehab and turn it around. You'll still be able to qualify for it for more properties because you have something called a portfolio loan where they'll do a blanket mortgage across all of the properties and they'll register the charge across and allow you to tap into the equity on those properties to then utilize for that next property and have that go through. And then once you go ahead, you do the rehab, turn it around, it's cash flowing, it's been stabilized, you can refinance that charge off and have everything free and clear again. So there's more creative options when it comes to the corporate style.
Yeah. And so here's one thing I think everyone need to understand because a lot of first time investors out there, oh my God, the interest rate. Keep in mind, some of these mortgage products are going to be higher than your 1.5% you're getting right now in mid 2021.
Yeah, exactly. And that's another thing too, Zen. Very similar to the taxes. I guess, the mortgage brokers would have the similar rants to me where, people would tend to get fed up about the interest rate. And it's like, oh, I'm paying 1% higher here, 2% higher, et cetera.
Yeah.
Oftentimes, again, if you're buying the right properties and they're cash flowing or they're going to be cash flowing, like you're going to make so much more money on the forced appreciation or on the deal than you are the interest rate. So it's kind of like you're shooting yourself in the foot to save pennies when you could be making dollars with some of these interest rates.
Oh yeah, for sure. Like the whole thing I tell everyone is like, don't miss the forest for the tree, right?
Yeah,
Everyone's so stuck looking at, oh my God, the interest rate. Oh no, my
yeah.
taxes. I'm like, yo, behind all of this, there's more money to be had, right?
Yeah, a ton, exactly. And it's interesting. Sometimes people just need to take a step back, and it
Yeah.
comes with experience. We tend to zone in a little bit more, but once you do finally see the bigger picture, and you've done the one property, and you get that experience, people definitely grow, and that's where they start building that momentum.
Yeah, absolutely. Like even in my instance, right? Like sometimes if we don't want to keep our incomes that high for reporting, I rather take a 2.56 interest small business loan from one of my banks than to have to report more taxes to qualify for more properties, right?
Yeah,
Like you just got to
yeah.
do that cost analysis, and this is why like experience as an investor is so much more important than just knowing the accounting rules.
Yeah, 100%. And like, especially with some of the bigger multifamilies that, me and my partners are doing now, like there's been times where we've paid some ridiculous broker fees and lender fees, which, seem very expensive. And our lawyer is almost dumbfounded every time where he's like, how are you guys paying this much? I'm in the wrong profession. However, when you realize that you're going to make much more money on the deal and this fee was the difference between you not doing the deal and you doing the deal, it's always worth it to pay it and generate that revenue.
And it is a hard kind of mindset to get out of, right? Like I find a lot of people who aren't into investing, or like even just like smaller thinking kind of like, people, they're like, I'm more focused on how much money you're making off me buying this, as opposed to I'm like, why don't you focus on how much money you're going to make if you hold this for 5 years?
Yeah, seriously. I couldn't agree more, man. Sometimes it really just takes that click for them to see the bigger picture. But
and
that's the
it's
wrong
hard.
thing to focus on.
And it's very hard until you actually kind of like realize what you're capable of, right? Because I think in our industry, there's very little of us who actually service investor clients and have investment properties. There's a lot of like, for lack of a better term, like phony fake gurus out there, right? And then they're just like, yeah, just buy this. It's good appreciation from like the real estate side, right?
Right,
And then they
right.
come to me, they're like, Zen, I can't even close this. I'm like, oh, wonderful. Okay, here's my guy, talk about it, right?
Yeah,
But like when you have good experienced like professionals on your side, really shouldn't be concerned about how much they're making or how much you're paying like your broker fee, right? Because
yeah,
like I know who with the broker fees we're talking like 3-4% on the mortgage, right?
yeah, exactly.
But at the end of the day, if you're gonna buy the property and you get your capital back out, right, it's just the cost of doing business, right?
Yep, exactly. And when you're looking at your deal holistically, factor those fees in, and if you're still going to be at a profitable thing that meets your targeted metrics, why not, right? Don't let the fees scare you from making serious money.
Yeah, for sure. So let me ask you this question then. If you have a client who has some properties under their personal name and they want to continue growing the portfolio, so they have some experience and they're seeing the forest instead of the tree now,
Yeah,
should they incorporate? Like say, like there are 2-3 properties, they make like okay income as a family over like 6 figures, right? Like that's generally the target demographic we work with, who have like borrow money from the primary residence to invest, right?
For sure. And is there plan to continue to purchase properties and scale up?
Yeah, scale it.
Yeah, in that case, I would say definitely, like, assuming the income is decent, the properties are bringing in good income from a tax perspective, as well as from just a strategic perspective, in order to scale up the portfolio. At that point, it would make sense for them to incorporate. But again, you don't incorporate one corporation, you incorporate all three and do utilize the 3-tiered structure. Yeah, go ahead.
Sorry, is there an instance where you can just do like 2 corporations? Like maybe you don't want to do the property management one and like, put it in later?
Yeah. So if you just wanted to set up the real estate company and have the holding company on top own it, you could do it. The only situation I would recommend that is if the properties you're going to be purchasing are going to be negative or break even. So, you're paying 50% tax on $0 or at a break even. So that wouldn't be as big of a concern. And then afterwards, become profitable and you do need to have that property management company, you could incorporate and set that up afterwards. So there are instances where you could do that. The only time, if I'm looking at my investors out there, that you can get away with just one corporation would be if you're a flipper. If you're just flipping, you're not going to be holding properties. You could put those properties in the one corporation. Flipping is inherently an active business in nature. It's an active activity. So that one corporation, your profits on your flip, it won't be treated as a capital gain. It'll be treated as active business income. And you're going to be paying the 12.2% tax rate on your net active business income.
Yeah, let's go down that. Let's go down that and explore that a little bit more. So if you incorporate, you buy the property in the property, and then it's owned by the corporation, you rehab it, renovate it, and then you sell in the corporation.
Yeah.
Your profits are now deemed active instead of passive, right?
Yeah, exactly. Correct. So for example, let's talk about the nightmare situation where you get caught flipping in your personal name. Because when you flip personally is when you get punished the hardest, right?
Yeah. So CR is after you. They're looking for those people, right?
Yeah, they have, especially with real estate booming, they're looking for a ton of flippers. So where you go ahead, you purchase the property, let's say for $500,000, you spent $100,000 on rehab, it's worth 600. Total cost base is now 600,000. Market goes insane, and now let's say it's worth $1 million.
I want to buy in your market.
Yeah, it's worth $1 million, right? So there's a $400,000 gain there. Now, if you had actually bought and held this property, rented it out for a few years, and then sold it, this would be treated as a capital gain. And of the 400,000, only 50% of that, which is 200,000, would be taxable and get added to your personal tax bracket. Now, but since this is a flip, you didn't hold it, you went ahead and flipped it. That it's not a capital gain. That entire $400,000 is considered active business income. So if you're making 100 grand a year, your total taxable income just became $500,000.
Yep.
So you shot right away into the top tax bracket, and after $220,000, you're paying 53 cents on the dollar, which is brutal.
It's
and
really
we're
nasty.
using big numbers. Even if we're talking small, like say you made 100 grand in capital gain, you just now added $100,000 to your taxable income, and it shot you up into the higher brackets. Versus if you were in a flipping company, that same entire amount would be treated as active business income. So the treatment would be the same. However, the tax rate for the active business income is going to be 12.2% versus on your personal side, the brackets are jumping. Now, another thing I should mention with active business income is it's going to be 12.2% up to the first 500,000. Once you pass $500,000 in active business income, it's 26.5% going forward.
That's a first world top 1% kind of problem to have.
Yeah. Something people should be aware of. I know there's some crazy flippers out there. So.
Oh yeah, for sure. But like, it's a good attribute for people to the corporation is a good thing for them to understand, because anyone who does a flip right away and they're like, oh, I'm going to go in here and sell it and say, I'm going to live in it for a little bit. You know how they stay for like 9 months to a year. Are they going to get away with it?
That it comes down to the CRA's discretion. Then, like, it really comes to the narrative. Like say they actually live in it, and they can support that they did so and showed that they sold it after 1 year. There's a good chance they can let that go. But if they're seeing a pattern of this, then that might warrant a deeper dive and them to ask more questions and cause some issues. So it really comes down to they may not just bag you on the one-time thing, but they look at the holistic picture as well.
Yeah, I know 2 people that got audited because they moved 3 times within 5 years.
Oh wow, yeah.
like they look actually legit moves, though. They're actually legit moves.
Okay, yeah. So that's good. Yeah, and then that's like I said, there's even cases on the flip end where you purchased it and you actually had to leave after 4 months. Like you were working from home, and now pandemic's slowing down, and they're deciding that you have to come back to work. So you decided to sell the property within less than a year, and you still wanted to claim this principal residence. Like presenting those facts to the CRA, there's a really good chance they will let you have the principal residence. So a lot of these things do come down to circumstance and the proof that you can have to back it up.
So even if you're doing, say, one flip based on, the amount of tax savings you have, right? So that $400,000 in your example, you're taxed at 12.5%. It makes sense to even just incorporate for one flip.
Yeah, it would, especially if you're going to be depending on if your personal income's high or not. Like if you had $0 in income and, the flip was going to make you under $100,000, it's still profitable. You're still going to come ahead with the 12.2% tax rate. The only other advantage is something we should probably talk about is once you've paid these taxes in the corporation, that money is the corporation's. If you were to then draw it from the corporation personally, you still have to pay taxes. So going back to that $0 situation.
Thank you for explaining it. That's my next question.
Yeah, if the guy was to only need like 40K of the profits that he made, still makes perfect sense to use the corporation. But if he was planning on pulling all the money out anyways, then he could have just done it in his personal name.
Yeah, exactly. I think one of the misconceptions when I talk to a lot of my friends who aren't in the, call it real estate or entrepreneurial space, they're just like, you have so many corporations, you must not pay any tax. And like, I don't think you understand. Like corporations are tax deferral. I still pay taxes.
yeah, exactly. It's kind of like, sometimes I'm able to relate to people by telling them it's kind of like your RRSP.
Yes.
You're putting your money in there, you get the deduction now, and now it sits in there, you can't touch it. But one day when you do pull it out, you're going to pay taxes right back on that same money. So that's how the corporation works, especially now. But why it's really advantageous to entrepreneurs like us, we're looking to scale and reinvest that money in the business. So now you're paying only 12.2% tax. You have all that extra money that you would have otherwise lost if you had taken the money personally to use in the corp and feed the business.
Exactly. And that's, I think, the unfair advantage, I'm going to say, for people who utilize a corporation, because you're using like about 30% of before tax money. I know it's not the proper term, right? But like, after corporate tax, but like before personal marginal tax rate, you actually reinvest that. So when you're talking about like, $100,000 down payments, that's like a 30 grand difference.
Yeah,
it's very substantial. It's very substantial.
It's huge. It makes a really big difference. And now you have the opportunity to also bracket management yourself. Like, let's say,
I like that term, bracket management. I want to steal that.
Yeah, because now your income is let's say your income is purely what you draw from your business, right? Whether it's flipping, real estate agent, etc. Now, instead of just pulling out 200K in one shot and shooting yourself up into the higher brackets, and based on your lifestyle and what needs you can manage your brackets, right? So you can look at it and say, okay, for my lifestyle and the cost that I need, even though my corporation just brought in 300K a year, I only need 80K. So you're going to pull out 80K, get into that second tax bracket and manage things a little better versus, like say if you weren't incorporated and all that money came to you personally, boom, you shoot into the top bracket and there goes half of it.
Yeah, the Canadian government will be happy, right?
yeah, exactly.
So I mean, let's dig into this a little bit more, right? So now, from the investor's perspective, like, what if I'm trying to qualify for more mortgages, right? So now I'm reporting more income just so I can qualify for more mortgages, right?
Yeah, exactly. So that's another thing we got to look at. And it really depends on the mortgage brokers and lenders that you're working with, right? Like some lenders will take just purely your corporation, which is showing a bunch of income. They'll look at the consistency there and say, okay, this corporation can debt service itself. We don't care if you make $0 personally, or if you're making 60, 70K personally, we're fine with that. We're going to use the corporation to qualify for the mortgages. Other lenders, and depending on how much history that your corporation has, will still want to see income on the personal side. So you will have to draw that money personally and pay taxes at the personal rate in order to qualify for those mortgages. So that it's very important to have that conversation with your lenders and determine the amount that you need. So you're not pulling out you need to, you can still qualify and not have the portfolio run into any
like challenges of qualifying for it, right? Yeah, and like we can talk about it briefly right now. And again, neither PV and I are mortgage brokers, right? But like we've seen this enough. Like I know on a corporate side, RBC is the one that does like gross up 35 down, right? And you can buy.
Yep.
We got guys for that. We have guys on Scotia that will use your personal income to qualify into the corporation.
Yep. I think Scotia recently brought back their retained earnings program too, where they'll take 60% of the retained.
I think it's only for select professionals.
Oh, right. Yeah, that's true.
Because they didn't bring it back for.
I'm an accountant.
So
that's right. Yeah.
I'm like, I'm getting shafted. It's only doctors, dentists, and accountants. What the hell?
Right. Sorry, I forgot. It was my guy was saying, "Hey, man, you can do this," and I'm like, "All right, true," but I forgot that it's because I was an accountant.
It's okay. My alternative now is TD small business loan, right?
Okay, nice.
So I think they're doing 20% down, 2.5, 6%, but they'll lend you, I think, 7 times your gross income or something like that.
Okay, wow.
Yeah, it's actually not bad, but like, and they don't take a broker fee, so it's kind of like a no broker fee B lender.
That's amazing. Yeah, and then that was the other thing I was gonna say is, let's say the big five are being very anal about, oh, you need to show this much personal income, or we're not going to take income on the corp. There's plenty of B lenders who, again, it's going to be more expensive, but you're going to be able to get the deal done with that overall, and you may even save money, right? So let's say we're working with a B lender who's willing to just take the income in the corporation and doesn't require you to show a minimum of, for example, $120,000 and pay all the taxes on that. It makes sense for you to pay a higher interest rate and pay the higher lender fee in order to have that lender give you the mortgage purely based on the corporation than be forced to draw 120 grand and pay the marginal taxes on that. So
exactly. I think when I try to explain this to people, I mean, it's their experience to understand, right? But when it's new, it's kind of like missing that forest for the tree again, right? Like if you're paying taxes on 120 grand, what is that, like 50 grand? Something like that.
Yeah, it's pretty steep. Yep.
Yeah, you're never going to get that back, right? It just goes to the tax man. But if you're paying, like, call it $80,000 in income, but you're paying, call it, 1% lender fee, which could be, I don't know, like 10 grand or something.
Yep.
And you pay a higher interest rate at 2.5 or something. both those components become, you can expense them as part of the corporation, right?
Good deal. Yep.
Exactly. So a lot of people just miss that, right? Like you got to just find the way to get the property and figure out the rest later.
Yeah, exactly. And just make that change in mindset where just because it's more expensive doesn't mean you're going to be worse off.
Yeah, I've seen some of the deals, like the breakdowns of private deals at like 8-9% and like 3% lender fee, and then I see what they do on the rehab and the rentals. I'm like, damn, it's pretty good. I'll do that all day.
Yeah, exactly. Especially once you know what you're doing, it's just giving you that opportunity to, with a lack for a better word, have unlimited borrowing power, right? If you can keep finding good deals that'll meet their criteria, and they've seen your track record as an investor, they'll be willing to lend you, and also lend out the rehab costs as well.
Yeah, no, absolutely, absolutely. So more on this like expensing thing. So a lot of people come across this. As a person who's borrowing from their house to buy like their first or whatever investment property, is it better? And this is a PV accountant question, okay? Not PV investor question.
Yeah.
Is it better to use a Heloc with the down payment to do the purchase, or do you refi your house and then you use that for the down?
Right. So both from purely an accounting perspective, Zen, it ends up being very similar in terms of the treatment. It's just with the Heloc. So both cases, let's say you refinance it or you use the Heloc, you could still write the interest off associated with the funds that you've invested into that property. So let's say you borrow 200 from your Heloc and invest it into a property, or you refinance your house and you get 200,000 in cash and you go and invest that. You can still write off the interest in both scenarios. It's just with the refinance, it requires more work to figure out specifically what the interest associated with that is going to be. Versus with the Heloc, it's very straightforward. It's essentially an interest-only loan where you're only going to be getting interest payments made on it, and then you're able to do that. Now, from more of a investor / personal finance perspective, it's
we're not giving advice. This is just information we're chatting. Okay.
Yeah.
Nobody come after us.
Yeah. Well, I'm not even going to give a recommendation, but
okay.
I'm going to say this is what it ultimately comes down to is with the Heloc, typically the interest rate is going to be higher, but you have that flexibility of drawing and paying it back as you need. So let's say, you were just going to purchase the one, you're in a BRRRR property. So you drew on the Heloc, purchased it, you're paying the interest, and now the renovations are done. You've BRRRRed it, you've got the 200K back, boom, you shove it right back into the Heloc and it's good to go. Whereas with the refinance, you've essentially refinanced and remortgaged the entire house. Like you can't just pay it down in one shot once the funds are done. So I would say if you're going to be an investor and you plan on continuously using that money and recycling it into other projects and not repaying that house down, it makes more sense to refinance it because you're going to get the lower interest rate and you're able to utilize those funds for your future acquisitions. The only trade-off is now you have to make principal and interest repayments on that new loan versus with the Heloc, it's just going to be interest-only payments.
Yeah, and this part is very hard to explain to clients because, like, with the refi, it's a lower cash flow because you're paying down principal. But with the Heloc, it's higher cash flow. You're not paying down principal.
Yeah, exactly. So that's a big thing you got to consider too.
Yeah, and it's one of those things where, like, from experience, you kind of have to line up what the client's strategy and goal is to actually give a recommendation. And again, like I'm going to keep harping on this. Like, this is why you need to kind of have someone who actually has investment experience, because the actual expertise of whatever the profession is not enough, because there's so many moving parts when it comes to the real estate, the mortgage, the accountant, and the legal.
For sure. Yeah, no, definitely. You got to have that power team.
Yeah, because like, when you ask an accountant and then a lawyer whether they should incorporate, no one will give you the same answer, and everyone has a different component to it.
Yeah, and they're looking at it from two different perspectives too. Like I'm sure the accountant will focus more on the taxes. The lawyer may look at legal liability or just like corporate structuring, and a lot of lawyers do know a bit about estate planning as well. So there'll be some different perspectives for sure.
Okay, let's dig deeper into the estate planning. We got a lot of clients who want to plan stuff to their kids, right? Let's talk accountant side first. How do you do that the most tax efficient way? And then from an investor side, if you were to pass on these properties to the kids, how would you do that?
Yeah, so it really depends on when you plan on doing it or what kind of involvement you plan on having with the kids in the portfolio. For example, like a family trust structure is one of the more popular ones.
Yeah.
And the reason why is because it gives you a lot of flexibility when it comes to designating beneficiaries and having each one of the beneficiaries paid an income. And eventually you're able to, freeze the valuation at a certain point and have all further growth attributed to your children from a certain perspective. So that it allows for more flexibility from a family trust perspective. I still recommend, well, I don't want to say use the word recommend, but a lot of my clients right now currently, since they're still not too worried about passing
Knock on wood.
it on to their
Yeah.
children just yet, knock on wood. We have it set up as, they're the primary owners of their three-tiered structure,
Yeah.
and we can use some of the CRA's tools with like share for share exchanges to essentially gift shares from the holding company of the three-tiered structure to the children when the time comes. So I think you still have a lot of flexibility in terms of options. So whether you're in the three-tiered structure or if you want to have essentially a family trust own your three-tiered structure, and it really comes down to, are you going to be paying the kids right now over the years once they hit a reasonable age, or are you at a point where you just want to completely gift it to them? So the answer is really going to vary based on your personal situation there, but those are some of the most common ways to do it.
So are you like assigning like different classes of shares that are dividend with like say voting rights to the kids so that they're like generating income from say the holding company at the top of the three tier?
But the three-tier, yeah,
Yeah.
you can structure things that way, and you can even structure it so that eventually their shares can be converted into the true ownership preferred shares at the
Mhm.
point where the parents want to give up the company and have them take over as well. So there's a few different ways to do this.
So let's talk about the more morbid stuff. What if someone passes and how do you deal with the probate?
With that, so yeah, that it's gonna really come down to how we have things set up. So typically with the probate, I like it. In an ideal situation, you do have a will in place, and
Yeah.
you have a gifting structure set up so that they can be gifted the shares at a certain valuation. Now with probates, and yeah, honestly, there's really gonna be a lot of moving pieces there. That I would say it's more of a in-depth conversation based on your personal situation.
Yeah. So at the end of this, if anyone is curious about some of the things that PV and I are talking about, I'll put a link to set up a call with him for like a consult. Because like
Mm,
we said right off the bat, like everything's very situational dependent on kind of what your specific needs are, right? Like there really is no kind of blanket answer for everyone, despite what everyone wants, right? Because I
yeah.
mean, for lack of a better term, the tax system's overly complicated.
Yeah, yeah, for sure. There's always a lot of moving pieces, and you got to understand each individual situation's pieces to then give that geared advice.
Yeah. Okay. So I'm going to switch gears a little bit. Like I
Sure.
have a lot of clients who do a lot of pre-con, right? And I have a
Yep.
lot of people I talk them out of pre-con. So if you are financing the down payment on the pre-cons, can you write that off without actually closing on the property if it came from a Heloc?
If you're saying to write off the interest
Yeah.
on the property,
Yeah.
so you won't be able to write it off until the property's actually ready. So actually, this can
Thank
go
you.
this can go two ways. Then, so in it, let's say if you actually close the property,
Yeah.
then you would essentially capitalize all of that interest you incurred to the value of the property, and then all interest occurred going forward after closing, you can write off. Now if this is specifically someone who's going to be assignment sailing pre-con, they're not going to be able to write it off until the actual sale happens, but at which point, like, you're going to get destroyed on the
Oh
taxes
yeah, it's
when it comes
nasty.
to it's like absolutely brutal. The entire thing, similar, going back to our flipping conversation, it's treated as a flip. So the entire 100% of your gain is considered active business income and is going to be taxable. And at which point, then you can write off your interest costs to date against that active business income.
It's insignificant compared to what you're going to
Pennies.
be.
It's absolute pennies compared to how hard you're going to get killed between the income tax on the 100% of that income, plus the HST that you're going to be paying on the deposits as well.
Oh, that stuff's nasty. A lot of people don't know about it, right? Like you're paying 13% on the amount of deposit you've paid.
Yeah, yeah,
It's
exactly.
nasty.
13, yeah, 13% on the amount of deposit. It gets rough.
Yeah, a lot of
Like,
people come up to me and they're like, "Hey, I'm thinking about investing in pre-con." I always ask them like, "What's your end strategy?" Like, "Oh, I'm going to sell it." I'm like, I'm like, without getting into the complicated things, like you realize the only people that make money are the realtors who sell you the property.
Yeah, yeah. It's the other thing I would say is, yeah, if you're not in a position to close the pre-con and hold it for at least a year, you're looking at some very, very serious tax
Oh
consequences.
yeah, now we're talking about that HST for not putting a tenant in or living yourself too, right? In addition to all of that stuff.
Yeah, and oh yeah, that's if you leave it vacant. That's even worse. I was thinking like close it, actually rent it out, keep it for a year, and then sell it. But yeah, you're right. If you leave it vacant, there's a no whole another tax
Oh,
associated
don't
with that
forget
as well.
the vacant tax coming in 2022.
Yeah,
That's going to add to it too.
yeah.
Yeah, so you got to just watch out for the pre-con stuff, right? Like a lot of, I've been very anti pre-con lately, and it's just
Mm.
like people, we still push like when I say us, I mean like us realtors are still pushing pre-con like crazy because they
Mhm.
pay well, right? But I'm just like,
Right.
I don't think it makes any sense anymore right now. It's very difficult unless like you got too much money, you just got to put it somewhere against inflation.
Yeah, I think like for the most, I agree with you. I think the only type of investor that it makes sense for is someone that really wants to be like purely hands off and is okay with a subpar return until a very long time
Yeah,
at
yeah,
these rates.
exactly.
Where, at least before back in the day, if let's say, the square foot price in Toronto was a thousand bucks per square feet, they would sell it to you at $1,000 a square feet. Then when it's ready 3 years later, it would have appreciated. But now we're seeing they're forecasting what the future valuation is going to be. So they're going to say, okay, even though it's 1,000 square feet right now, by the time this is done, it's going to be 1,400 per square foot in Toronto. Pay me 1,400 today, 3 years in advance.
Yeah.
So there's like a valuation risk there as well when it comes to your mortgage appraisal coming in.
Oh yeah, people don't think about it because like if that thing gets underappraised, you are so underwater.
Yeah, you're in a lot of trouble.
Yeah. So like where this all stemmed from is like the rumor mill how like I think it was back in 2014 we were buying pre-cons with like 5% down, like the remaining inventory from the builders. They're like,
Yeah,
here, just take it. It takes 2-3 years and then
yeah,
5%, and you can only pay 13% of the 5%. And
yeah,
then the thing got delayed and then wasn't ready till like 2018. And then we had like a condo boom of like 30%. And he was like, oh, I paid 20 grand. I made $140,000. And it was like, oh, I need to assign. I'm like, that doesn't happen anymore.
yeah. No, those opportunities are it's definitely seem to be gone.
Yeah, for sure. All right. So why don't you tell us if you're okay sharing, like, what are you doing from the investor side? No, because you are obviously most pervy to all the people's numbers.
Yeah.
So you have an
So
inside track on who's doing well and who isn't.
oh man, that's hilarious. Yeah. So me and my team personally, Zen, the four of us, we have a corporation called Foundation Capital Holdings, where we go and we're essentially burring multifamily apartment buildings. So, did a lot of the single family duplexes, triplexes, fourplexes, etc. The burr strategy. Now the fundamentals are the same. There's a few, different intricacies that you have to understand when it comes to financing, or even something like the phase ones, the phase twos,
Oh,
etc.
the environmentals are nasty, man.
Yeah, yeah. But for the most part, the fundamentals are the same. Now you're just doing it on a bigger scale. And the name of the game is getting tenant turnover. So essentially what I'm doing from the investment side is we're buying these bigger apartment buildings, going in. And the key thing with these apartment buildings is the valuation is not driven by the comparables. It's driven by the net operating income of the building. So
That
you got to go, yeah, exactly. You got to go in there, turn over the lower paying rents, renovate the units, make them nicer, have them come in at higher rents, increase the net operating income of the building, which is now going to increase the valuation. And then you refinance at the new valuation and you burn the money out. So that's what we've been doing and scaling pretty aggressively this past 2 years.
Yeah, we did that with like a lot of when I was in commercial real estate back, we do that for a lot of clients. And when
Mm.
you understand the cap rate of increasing $100 a month in rent relative to like a 3 or 4 cap, you're like, huh,
Yeah,
hmm.
it's crazy. Like, especially based on the cap rates, like you said, like for us, there was instances where we used to have some of the buildings had general coin laundries
Oh yeah,
in a general space, but we realized if we actually spend the extra, $6,000 per unit to put stackable laundry inside each unit, and therefore now we can increase the rent by $150. Like the net impact that's going to
so
have
much
on the
bigger.
valuation is crazy compared to the 6K per unit that we're
Yeah,
spending.
yeah, exactly. Like you're obviously putting more money into it, and then it's a very effective strategy to take money and earn money and like use other people's money. But it is a more advanced strategy, right? Like you really have to know what you're doing, because one, you have to understand kind of the mortgage side, the accounting side. You have to actually find these apartment buildings because no one's getting rid of them. You're door knocking at everybody, trying to find old listings to get people to sell it to you, let them blend the thing, right? Yeah, I've gone down the whole rabbit hole with it. Yeah,
for sure. Yeah, there's just a completely different thing. Like going on market doesn't always do the job when it comes specifically to some of these big ones. So yeah, you're right.
Yeah, but like I've seen some clients do it too, and like it's very like if you understand it, it's quite easy, because like the general thing is like, laminate floors, laminate countertops that look like stone, put some pot lights in, cut up some more rooms, cash for keys, get them out, increase the rent, double the value, and then now you're basically like refinancing and getting paid like a few $100,000, right?
Yeah, exactly. You're doing the same thing, just on a bigger scale. So, you're diverting your attention to a bigger project at once versus, doing the same thing in a smaller scale.
Yeah. But how long are you guys taking to turn over these things? I'd imagine it's got to be almost like 1 or 2 years to actually get the money out, right?
Exactly. So it's funny is that like initially with some of these bigger ones, like our first one we did was a 17 unit. So per our pro forma, we were expecting it to take almost 2.5 years to do it. And we thought that was aggressive. For that one worked out really well. We were able to get it turned over in like 8 months, actually. I guess it's sometimes you just get lucky, right? The tenants were willing to just take the cash and go kind of thing. And we were able to get that one turned over in 8 months. Whereas on the other one, the very next one we did, which was a 14 unit, we're 2 years in, and still we've only gotten 50% of the turnovers, got a few more coming. So we usually set like a 3 to 5 year timeline for each one of these to do it. And again, depending on the number of units, it can get even bigger.
Oh yeah, absolutely, right. But are you guys refinancing it only when the numbers make sense, where you get all your capital plus more out, or you kind of just do it in different phases?
Exactly. So for across the board, so far we've had 3 refinances go through. All of them
on one apartment.
No, on 3 separate.
Oh, okay. I'm like, wow, that thing really.
No. Yeah, no. But on three separate apartments, and on each one, we made sure that based on the net operating income, that valuation was where we wanted it to be. So we wanted each one to be at the very least a full BRRRR, if not more, and that's how it's worked out so far.
So from like your team, I imagine you got someone managing, boots on the ground, someone acquiring stuff. I'm sure you're managing the books, right? Your value add to the company.
Yeah, exactly. So actually me and my partner in the accounting practice, our responsibility is we handle all things finance. We deal with the money partners and JV partners, private lending, all that kind of stuff. So that's our role. And then we have our other 2 partners who are responsible for acquisitions as well as the management as well. And man, like one of the biggest game changers for us was hiring a full-time property manager to manage all of the buildings versus dealing with the external ones. Like it's been a huge change.
But now you're gonna have to put that into your statement for the NOI. But do you split that property management between your 3 apartments?
Yeah. So we split them amongst all of them because she does manage all of them. Yep.
Yeah, you know what it is, like when you grow, I think just kind of like where we are right now, when you grow enough, like it's not about the money you get, it's the quality of life. You just got to hire somebody to make your life better. You can't penny pinch every dollar.
Yeah, 100%, man. And it's funny, we were just talking about this earlier too, where there was a situation where I took lower rents on one of my properties because I knew the tenant profile was just going to be so much more better, which means less headaches versus the ones we're going to pay top of market.
Yeah, absolutely. Right. Because like for that $100 in cash flow, if you're investing, if it's going to make or break you, you may want to consider just not investing. Right. Because at the end of the day, like the way I kind of position the 3 ways you get paid in real estate, like cash flow, mortgage pay down, and appreciation, is cash flow. Like a lot of people, go by the BRRRR or fire movement and they try to take the, like replace their income with cash flow. It's very difficult unless you go into like smaller apartment buildings or you're recycling your money infinitely, right? Mm-hmm. And that's a full-time job on its own. But where you're doing this as a side hustle, and there's a difference between like, your mom and pop investors, is you make most of your money guaranteed on the mortgage pay down. And if there's any appreciation afterwards, right?
Yeah, exactly. And it's something that I don't think a lot of people will understand until they've lived it. But like that peace of mind is going to be so much better than just the dollars.
Yeah, yeah. It's the thinking that people say, like, oh, Zen, you own so many properties. Like, what happens if your toilet clogs at 2 a.m.? Like, yo, I'm not driving to wherever my
Yeah,
property is, right? At
yeah,
2
yeah.
a.m. I'm like, there's an emergency plumber. I'll pay for it after.
Yeah, yeah, exactly. No, for sure. And that's how you're gonna make it sustainable too. Because if you're gonna try to penny pinch and manage all of this yourself, you are gonna get burnt out. And the cost of that is gonna be much more significant than the cost of those little expenses that add up.
Yeah, absolutely. Because like I think people forget that investing is like a business, right? Look, so if you're
Mhm.
doing all the work, even if it's like minor, $10, $15 an hour kind of work, that's your time. Your
Yeah,
time's better off doing, for lack of a better term, like frying the bigger fish, right?
yeah, yeah,
Finding the next property to acquire, talking to JV partners, getting money to get ready for the next purchase, right? That's
yeah,
where you make
sure.
most of your money, not, fixing toilets and stuff.
Yeah, yeah, exactly. Then trust me. So like having the right people in place to help with your management and even do the tasks that are going to allow you to focus on the higher revenue items is very important.
Yeah, absolutely. So are you still holding any kind of like single family stuff in your portfolio?
I have three just small single families that I'm still holding on to just around the GTA,
Yeah.
and then otherwise for the most part it's the multifamilies out there.
Yeah. I find once people get to the multifam stuff, they're like, yeah, I'm not going to go back. It's just like the deal process is so slow.
Right, right. Yeah, exactly. Like I'll occasionally still do a flip here and there.
Hmm.
If I'm able to get it fundamentally at a good value and quickly turn it around and doesn't require too much management. But otherwise, for the most part, the focus is on the multifamily.
Yeah, exactly. I think same thing for us. It's just like, it's not sometimes worth the money to deal with like renovations if you don't have the expertise for it, or like
Yeah,
your guys just aren't ready. I mean, you just buy
yeah,
the property and just hold on to it, right?
yeah, exactly.
Yeah, yeah, yeah. So like, I mean, this is just again, if anyone who's listening, this is just us kind of like shooting the breeze. Like, don't take this for like advice, but we're just
Yeah,
giving you our experience from our professions plus being an investor, right?
yeah, for sure. And just our perspectives.
Yeah.
That's the thing with real estate. It's very simple in concept wise. I
Oh,
like to say
so
it's
simple.
simple but not easy.
Yes.
Very
Yes.
simple, but it's not easy.
Yeah. And people I find overcomplicate it too much. They're like, oh, what do I need to do X, Y, Z? I'm like, look, man, just get the property and figure it out after.
Yeah, yeah. And I think another thing is that I've experienced, especially, coming from my parents who were immigrants, and like for them, they tend to look at houses as like, oh, it's a house. It's a
Yeah.
much bigger deal to them. Like it needs to be good, livable, etc. Whereas for me, I look at homes as like stocks, it's just an asset. Like even if I couldn't see, touch, or feel it, that's fine. It just needs to do what it is meant to do.
Oh yeah, it's a totally different mindset, like our parents' generation, if they bought a house in Canada, they were paying what 15-17% interest rate. We're at
Yeah,
like 1.5. I mean, people don't realize like if inflation is 2% and you're borrowing at 1.5, you're automatically gaining 0.5.
yeah,
Then like I'm not going to get all the economical and stuff, but like when you have like a giant hurdle rate of like money being printed at 20% a year, I'm like, yo, you're not
yeah.
making 20% increase, you're screwed.
It's scary, man.
Yeah.
And that's why you can't just be keeping the cash in the bank either. You got to be deploying them into assets.
Oh, that's why I asked him, like, hey, what do I do? I'm like, can I buy other things? You just
Yeah,
gotta find a place to like store it, because otherwise, like, if you're, I think this is my math that scares me. Like, if it's 20% every single year hurdle rate, that means every month I'm like out 1 point something percent on all my money. I'm like, oh God, I'm itching. It's gotta go somewhere.
yeah, yeah, exactly, man. You got to put them in assets for sure.
Yeah, yeah, no, for sure. No, this is good. I think having a more candid conversation like about
Mhm.
this gives different light into certain things for like our clients, right? Because
Yeah,
you don't see the full picture until you kind of run through it. And like when I was younger, I'm like, oh, experience, whatever, getting a job. And now I'm like, oh, experience.
yeah, yeah. Exactly. See, the experience will save you a lot of the headaches, but you got to go through the headaches to get the experience. So it's kind of a circular thing.
Yeah, you kind of like as an entrepreneur, you kind of have to fail enough times to understand why you shouldn't do it that way to
Mhm.
actually get better. Because I don't know about you, but like I'm not like the most book smart person, but like if I can understand why people have failed, or like I failed miserably myself, like facing the floor kind of thing, I'm like,
Mhm.
yeah, I'm not going to do that again.
Right, right. Yeah, for sure. You just take that experience and learn from it.
Yeah, for sure. All right, people, I'm not going to get up too much time,
Yeah.
but I do have some questions that my clients wanted me to ask you.
Sure.
So if they're kind of looking for an accountant, what's the difference between kind of like you as an accountant versus other accountants, and how do you differentiate them?
Yeah, for sure. I think, like I mentioned earlier, the key thing that I bring as a difference as an accountant is I do have that investor background as well, very experienced real estate investor. So I'll be able to provide that advice not only from a tax perspective, but holistically as an investor as well. So we can look at things not just from a tax efficient manner, but from a strategic perspective as well to make sure that the move that we're going to make fits in with your overall plan and overall strategy. And, we're good on all fronts there. So I think that would be the key piece of my key offering that I'd be able to bring to the table versus the other accountants.
Yeah, like I can vouch for that too, because like sometimes when I want to do something crazy, I'm like, well, I need an accountant to check if this works, right?
Yeah.
But then like I'm like, yeah, this accountant needs to be invested to understand why I'm doing it this way too. I'm like, you gotta understand, like
Right.
I gotta get some more mortgages. I'm like, what's the most I should report before I, get cut off from certain banks and stuff. It's a
Right.
really big difference.
Yeah. Yeah. For sure.
Yeah, that's for sure. Because that's one. I got another one. This one maybe a little bit longer, but this one's
Okay.
interesting. If you're retiring, how do you structure kind of living off your investments, right? From the cap gains, the if you were to sell it or not, or living off of cash flow.
Yeah. How would you structure it? So
Yeah.
the number one thing I would need to know is how much money would you need to live to support the lifestyle that you want to have. That being said, once we know that number, depending on how your investments, what vehicles they're currently structured in is going to be a big play. So, going back to our earlier conversation, if you have all of your properties within that three-tiered structure now, and you have a bunch of retained earnings built up within the corporation, you've now retired. Again, now you can do what we call bracket management and slowly take it out over the years. So, you've retired now, knock on wood, you have another 35 years on the planet, you can slowly draw that money over and manage the bracket so you're not paying crazy personal taxes. That being said, if you do need to have more, again, if it's around that 100,000 mark, 150,000 mark, you're going to pay more taxes over it. But having your income in that corporation will give you the opportunity to draw it over time and not get hit with it all at once.
Yeah, I think
Right.
from my understanding, it's kind of like if you somehow, sell some things like properties you don't like and you deleverage, so you pay things off, and then you
Mhm.
leave the rest of it inside a corporation of that manner, and you just draw what you need for living, right? Because I imagine most of people's cost of living and their income goes towards servicing some kind of mortgage, right?
Mhm. Yeah.
So if then, you have a paid off house, then you're just living off of like deferred income bracket management in the corporations that you set
Right,
up, right?
right. For sure. And then, the key thing in this is where the asset is owned in the first
Oh,
place.
yes,
Like,
yes, yes, yeah.
if it's already owned by you personally, then you're kind of stuck with you have to, when you sell it, all that income is going to get realized right away. And then you have the after tax cash to use right away as well. But that income can get pretty high depending on how much that amount is. So especially if it's already in a corporate structure and you're able to sell it, deleverage, and then now have that retained earnings, you can slowly pay yourself over the years and enjoy your retirement.
Well, what if you sell something in a corporation and you kind of take the earnings out slowly? Would that work as well?
If it's already in the corporation,
Yeah.
yeah, exactly. That's what I am saying. Like
Oh,
if
I
they
see. I
and
see.
the
Okay. Yeah.
assets already in the corporation, that's where you have that flexibility. Versus if it's already personal, then it's a little tough. Now, let's say it's in a situation where it's already personal. You sell it, you eat the taxes, and now you have all of that cash. Now, if you're going to invest that cash into something that's going to then pay you an interest, like for example, let's say you were to lend a secured mortgage or something like that, you can then utilize that cash and earn that income slowly over time. Depending on how much lending you're going to do, you could do it through a corporation as well and have it as like a active lending company and slowly draw what you need from the retained earnings as well.
For sure. So what PV is saying is you got money to lend him for his multi-res stuff, talk.
Yeah, for sure. Why not? That's been a great way that I myself, we borrow for the company as well, but I also lend a lot of my personal funds too.
Oh, for
It's
sure.
definitely one of the best passive income ways as well.
Yeah.
You need to be in everything, right? Real estate,
Yeah.
some private lending, mortgage investment corporations are another popular tool as
Mix
well.
for anyone who is paying attention. Yeah.
Yep.
Oh, actually, I got one thing. You want to hear my hot take about RSPs? I'm going to get your opinion on that.
Yeah,
All
yeah,
right.
go
So
for it.
if you are paying money into an RSP, right? And you can't take it out until you're 65 without penalty.
Mhm.
If wouldn't it just be better if you know you're going to make a higher rate of return on real estate to just eat the tax now and put it into real estate? Because you can't do real estate in RSP unless it's like, a MIC or like a, mortgage syndicated kind of thing, right?
Yeah, yeah, I completely agree with
Oh,
that.
okay.
Like,
I thought I have
sometimes
what
I
it
go
takes.
as far
Okay.
as saying even hotter takes as a joke. I say RSPs are a scam
No, they
because
are. Oh
they're
my
taking
God.
they're taking your money and getting you like 2-3% return on it, and it's just stuck there for the next longest while when you could have been utilized that money, pay the taxes on that contribution, and utilize that cash to make even more money with real
Yeah,
estate or lending or any other type of investment.
100%. I think it makes sense if like your corporate company kind of matches your salary, or sorry, matches your
Mhm.
contribution like 1-to-1, right? And
Yep,
you're getting free money.
yep,
But like my
exactly.
whole thing and why I think it's a scam is like when I look at it, I'm like, yo, you're expecting me to make less money when I retire, but I have all this passive income. I ain't making less money, right? I'm like,
Yeah,
just give
yeah.
me my money now.
Yeah, and the opportunity cost of
Yes.
having your cash tied up is just brutal. So yeah, I'd go as far as to say it's a scam to maybe to just keep the banks a little bit more liquid.
Well, because the problem is like a lot of people, they listen to, quote unquote gurus and they're like, oh yeah, the RSPs are a great idea, but they don't realize like it's a vehicle, right? And they just leave it in like a guaranteed, like was a high interest account, right? For like 1 or 2%. I'm like, you're losing value.
Yeah, yeah, exactly. Like the only time I would support RSP is if someone's set on using it to again get that one-to-one contribution, or they just want the deduction for whatever reason, they're confident that their income is going to be lower.
Yeah.
Put it in and you can still lend through your RSP and get
Yeah.
secured mortgage or something, which will pay you better. But if you're going to be doing the 1 to 2% thing, like it's just
It's
doesn't make sense.
Yeah, so like at the very least, if you do have RSP, you can at least find kind of like people you can lend the money to, right? So again, I'm not
Mhm.
pitching you to lend money to PV. I'm just saying like
Yeah.
if he needs money for his apartment buildings and he's guaranteeing you a good return, like talk to him.
Yeah, yeah, for sure.
I'm pretty sure your returns promise will be better than any of the 1 or 2% with mutual funds.
Yeah. Yeah, like our last one that we did, we raised the money for the building
Yeah,
completely through private investors, so secured RSPs through Olympia Trust.
yeah,
ten
exactly.
percent
Yeah, yeah.
was the interest rate that we were paying, and that makes sense for us because we're going to burr the building and make more money on the other side, and 10% is a pretty good return for most people's RSPs.
Yeah, absolutely. I've thought about that stuff when Olympia started. I think it was like 5 or 7 years ago. It made
Mhm.
total sense because like you could recycle money, everyone wins, the investors get a higher rate of return, you get an asset, and then you guys manage it and you provide your expertise, right? Yeah,
Yeah, yeah, for
it sounds like you
sure.
guys have a really good team going on with the four guys for sure. Yeah.
Yeah, thanks, man. Appreciate
Yeah,
it.
because when I looked at it, I'm like, yeah, I can do this, I can do this. And then like I opened the brokerage, I was like, oh God, I can't do this, I can't do this, I can't do this. It's a lot of
Sure.
work, man. It's a lot of work.
Yeah, yeah,
Yeah. All right, man. I got two more
yeah.
questions. I'm going to be
Sure.
respectful of your time. So
Yeah.
I got one more where marginal cap gains, right? I think
Mhm.
there's a client of mine who's asking if you were to sell something and you gain capital gains tax, it's not even that much, right? Because it's a percentage of a percent. And I
Mhm.
guess let me just verify the question or repeat the question some more. So like capital gains tax is 50% of whatever it is you gain, but you only pay a percentage of that based on a capital gain marginal rate, right?
Right. So with if you're holding the property personally,
Yeah.
you're going to have your total capital gain, right? Let's say it's $100,000. You're going to pay 50%. You're going to pay tax on 50% of the gain. So only 50% is taxable. So out of the 100K, 50 grand is what's going to be taxable. Now that 50 grand is going to get added to your total taxable income, and depending at whatever marginal rate you fall at, that's what taxes you're going to pay. So yes, you do pay a percentage on the 50% of the total gain. So let's say you had $0 in income and you made $100,000 capital gain. Boom, your taxable income is now only going to be 50%. Sorry, your taxable gain is going to be 50% of the amount. So 50,000 is your taxable income. Now the first tax bracket, you're paying 15% at the first 45 grand for federally, and then like 7% provincially, right? So let's call it 21%. She's going to pay 21% on the $50,000.
Okay, got it. But isn't the marginal capital gains tax rate different from your actual marginal gains rate? Like it's lower, is it?
So no, so the capital gains, there's like it's going to be added to your overall taxable income. They don't hit it with a separate marginal rate. Like the rate is applied to
Oh,
all the taxable income.
okay. Yeah. So
With,
I think
with,
that answered their
yeah.
question. Yeah. Because
So with corporations, there's separate tax rates for capital gains and
got it.
passive
Because
incomes.
I think the question, and I didn't know how to answer it too. I was like, I think it originated from like an EY take home calculator where there's like a
Mhm.
different line item for marginal capital gains versus marginal tax rate.
Right. If for Canadian taxes,
Yeah, for
because
Canadian
I know in the
tax.
States they have it different thing, and it was for personal.
Yeah, so personal. That's why I wasn't really sure. I
Yeah.
was like, okay, let me ask PV.
Yeah. No, so typically it's just added into your taxable income and applied at the same tax rate.
Okay, well, you know who you are if you ask the question. You watch
Yeah,
this.
yeah. Yeah.
All right, PV. Thank you so much for your time. Anything you want to leave
Yeah.
off of all the people who are listening, watching, or whatever?
Yeah, for sure. I think a lot of the things that we spoke about today, guys don't get too focused on the tax dollar amounts or the interest costs, lender fees, and things like that when it comes to real estate investing. Like, take a step back and look at that bigger picture. And if you're in a position where your deal is going to pay you more long term, those you got to treat those costs as costs of businesses, and go out there and get those deals done.
Yeah, I absolutely can't have said it better myself. So if anyone wants to reach out to you, what's the best way?
Yeah, so you can reach out to us through our website, galleoncpa.ca, and then there's a contact us box, which you can fill out, and someone from our team will reach out to you for next steps. And then if you're interested in booking a consultation, then there's that link you can share with them as well.
Yeah, so I'll put the link in the video and the podcast for anyone who wants to talk to PV about kind of some of these things. I will say it's hard to get a good accountant, right? So I will brace everyone saying good advice costs money. I will say that, right? Because I know there's a lot of people who are like, hey, Zan, can I talk to your accountant? Can I talk to your accountant? I'm like, well, you should, everyone wants free tax advice, right?
Yeah. For sure. And you know what? There's also another saying that a good accountant is actually cheap, because the amount of money you save or the problems that you are able to dodge end up paying for themselves.
I can verify that. Anyone who's used Uncle Bob's kind of an accountant and they neglect a lot of these things, they get royally screwed in a year or two when they get an audit.
For sure.
Yeah. So don't cheap out. All right, PV, thank you so much for your time. Appreciate it. If anyone has any other further questions, maybe can I book you for a further down the line for any other kind of tips to come back on the podcast?
Yeah, for sure, man. Love to do it.
Cool, man. I'm just booking in advance and putting on record. All right, thanks, man. Appreciate it. Okay, we'll chat soon.
Cool. No problem. Talk soon.
Right, bye. So I hope you guys all enjoyed that episode of Prime Prop Steel podcast with PV. The kind of takeaway home, in talking to him for quite some time is, we always miss the forest for the tree, right? And from speaking from experience and doing this a long time, from both our perspectives, right, as a realtor and also as an accountant. And keep in mind, the accountants see all the numbers, right? Like we know real estate is a long-term game, so you don't want to miss the forest for the tree where you're just so focused on the interest rate or little small things, paying a little bit more for the property. But if long term it's going to work, it's like it makes sense even if it's a little bit of a hiccup in the beginning. Like we know it's a little bit hard in the beginning because you haven't seen the gains that real estate can provide for you, right? But this is where you got to lean on kind of those who have the experience to kind of guide you through it. And that's kind of what we're ultimately hoping to do, right? So when you listen to their conversation, you probably hear, both our passions come through about kind of like, the chaos that is the world and, the crazy stories that we have investing in real estate. But at the end of the day, like we're here to help you guys. And if you have any questions on like how to invest or even some of the things we go deeper into, you can reach me using the link on the screen, which is www.chowzen.com, or you can reach PV to reach him. His link is in the description of the podcast or in the description for the YouTube as well. Okay. All right. Talk to you guys next time. See ya. Bye.